All right, hello guys. Hello, how are we all doing? Let's do another live stream right now. Let me know, guys, where you guys are coming from, because for me, it's already getting quite late. It's already 10:30, and in just 26 minutes time, we are about to have another first Federal Reserve interest rate decision, and with a very high probability, with 87%, or let me refresh right now. I think it's even higher. Let me get the actual live data at this current moment. Yeah, with an 89.4% probability, we are about to see another 25 basis point rate cut. And that will be pretty exciting. Now, it will be pretty not only the rate cut. And the rate cut is actually not going to be that exciting itself. What will be very important to be watching will be the FOMC meeting and will be the dot plot. And then also we might be having a look into potential clues for MBS or T-bill purchases, minor QE, and also any kind of notes about quantitative tightening or quantitative easing coming up. That is going to be massively bullish, and we will need to be watching that in today's Fed meeting. So that is why I'm saying, yes, of course, the FOMC meeting initially will be pretty, the Fed rate cut will be pretty bullish for the long-term price action for all of our assets like Bitcoin, Ethereum, or our altcoins. It will be massively bullish for the long term. However, for now, what the market is really anticipating and waiting for is going to be both the dot plot, also some minor QE, or any notes or sayings, bullish things said about quantitative easing or quantitative tightening ending, right? Then also looking into this tweet over here from Joshua, well, then also we can potentially have a look into Q1, Q2, maybe Powell resigning. Okay, if anything like that will be stated during the meeting, of course, we are going to be seeing some bullish price action. Now, the unexpected scenarios will be no rate cuts, but yeah, that's not going to be so likely. Always, whenever I've seen about a 90% probability, that probability has always come out. Okay, so I do think that once again, with this 90% probability, will be very likely that this will actually happen. So, or a clearly hawkish statement. Not really going to be expecting this either. Now, why? Because the labor market is also still weakening. Inflation is actually dropping again a little bit, just ever so slightly, as you can see right over here on Trueflation. It is dropping ever so slightly again. So these are the perfect metrics that the Fed wants to see. So there's not going to be any sort of worry. I mean, the Fed is following its trajectory, right? Now, the only thing they could probably say is that, which could be hawkish, is that by the end of 2026, they're not looking to be cutting anymore, right? But right now, as of right now, maybe they could say up until middle of 2026, we're not looking to be cutting as well, right? Looking at the probabilities. But let's see about that. Let's see if some hawkish statement will be coming out. I do not think so. I am not going to be anticipating that myself. So, in my opinion, I do think that the markets could react pretty positively in towards today's meeting. Now, this is really pretty contrarian to my other belief, where I've been saying that always we have been seeing a bit of a buy the rumors event and then a sell the news event after the rate cut. But honestly, it will all just depend on what will be said today during the Fed meeting, and it will all just depend on the dot plot. So these are going to be the most important things we will need to have a look into. And the great thing for you guys is that we're going to have a look into it live. So make sure to stick around in the stream and grab something nice. Let me know what time it is for you guys, because for me it's already 10:40. Quite honestly, I'm already getting a little bit tired, but it's quite crazy that even though we are getting a little bit tired, we're still having a look into important economical data. We're still having a look into the markets. we're still like at this time, this late, still having a look into the markets. That is quite good, right? It's actually quite good. It's not that bad that we're doing this, right? It's not that bad. Anyways, also one thing that I wanted to share is that 2bit was so nice that only for this live stream, if you reach a trading volume over 50,000 US dollars, you will get another 50 USD free bonus. So this is only for the live stream only. Register, deposit, and trade with Mr. Crypto to get this free bonus. So yeah, you can use this link, any link of mine, and then you'll be getting that bonus. Only this event will only be available during the live stream. So yeah, if you already have an account over on 2bit, make sure to trade a little bit during the live stream for the FOMC meeting. And yeah, if you do not have an account yet on 2bit, you can also claim a free 50 USDT bonus after register, some big deposit bonuses, trading dash, and of course make sure to check out all the terms and conditions, right? So yeah, that's pretty generous of 2bit that they're giving away this free money if you're trading a little bit, just slightly over on 2bit, okay? So yeah, that is basically where we're going to be watching out for. That is basically what we're going to be having a look into. Now, like I've said, usually we do see a bit of a sell the news event after this FOMC meeting. But honestly, it is just going to be all depending on what will be said during the FOMC meeting. Because honestly, if it will be very bullish, of course, I mean, I do see the very, very big potential, highly likely scenario outcome to be to break above this level of resistance, to break this bear flag pattern out to the upside, to break this ascending triangle out to the upside. Now, of course, if it's going to be a little bit more of a bearish meeting, like not as anticipated, not incredibly bullish, well, then obviously I do think that still we can be grabbing the lows and then push to the upside, right? This is exactly what I've been saying in my latest few videos. We are coming to that decision moment now. We are coming to that FOMC meeting now, and we will need to make a decision whether we see this push to the upside already, or if we first come to the downside, grab the lows, and then see the push to the upside. So that is basically the question, and the answer we will be getting today during today's event. When is FOMC? In 20 minutes. Yeah, so the rate cut decision or rate decision is in 20 minutes. And then the FOMC meeting itself is in 50 minutes, always half an hour later after the FOMC meeting. But also already, or half an hour later as the interest rate decision. But also already always during the interest rate decision, a full report tends to be released as well, where usually in this report, some pretty important data is already shared in. So yeah, both will be pretty important. Hello, Mr. Crypto. Welcome to the stream. ETH is skyrocketing. Is Ethereum skyrocketing now? Let's have. Yeah, it is. It is doing pretty well. Let me open up another chart. So probably people are so we're touching a massive level of resistance now. No, but probably people are going to be expecting some bullish statements from Powell, right? Maybe regarding QE. Maybe, I mean, the market is taking this FOMC meeting quite well, right? So that's looking pretty bullish. We're already leading up to this event with a bullish pump. So let's see if we can continue this. That would be pretty interesting. 8/12. Well, congratulations that you're still watching. I also saw 2:30 somewhere, so that's absolutely 2:30 a.m. That's absolutely insane. You are a maniac. You're a maniac. You're absolutely crazy that you're still watching. I mean, I get it, right? It's gonna be important. It's gonna be an important event, but like at 2:30 a.m., that's absolutely crazy. I mean, you are grinding like literally very, very hard. That is crazy. Hi from Greece. Welcome to the stream. I absolutely love Greece. So hello from Greece. Yeah, let's go. First 96K, then 78K. Let's see about that. That could happen. I mean, yeah, I mean, just a push to the upside, shake everybody out. Then again to 82 or 78, sorry. Grab the lows and then boom. Let's see about that. Thank you, no problem. Eat pumping, yes. So, hi from the Netherlands, by the way. Welcome to the stream, Karup. What's your prediction after the federal interest rate cut, where you see the Bitcoin price? So, like I've shared, it is really going to be very dependent on what will be said during the meeting and what the dot plot will be. Now, honestly, I've been sharing this for quite a long time, right? I do think that the rate cuts we're getting now are going to be very bullish for the long term. Price action for Bitcoin, etc. We can be seeing a very nice push to the upside again, but I think it will be very delayed. And first, I mean, the Fed is too late with cutting the rates. We're gonna see some crashes, maybe in the economy, some things collapsing, right? And we're gonna see some crashes, maybe like a mini bear market. Okay, so definitely, I think a bear market for Bitcoin and some weakening price action. But ultimately, these interest rate cuts are going to be very bullish. Okay, and right now the Fed is setting up for the perfect storm to be cutting rates, with inflation probably decreasing a little bit within the next couple of months, with the labor market actually weakening. And this is exactly what the Fed needs in order to cut the rates. If the labor market is weakening, they want to stimulate the market, and the lower inflation rate allows them to do that. So let's see if that will actually happen. Are you friends with Crypto Rover? Feel like you two guys have similar opinions and narratives about the markets usually. I mean, man, it's because I'm good friends with Rover, and also we kind of grew up with each other. We grew up trading with each other. I mean, not grew up with each other, but since the moment we both started trading, we pretty much met. So we both started trading at the same time, and we learned everything on the way. And that's why, and also we are discussing markets so often. So I don't really watch his channel like at all, really, at all. He doesn't really watch my channel at all. But we still just have some discussions sometimes, right? And usually our views on the markets are pretty aligned, very aligned usually. So yeah, that's pretty interesting. I think it's just because we sometimes talk with each other and we learned everything the same way. And also, I would like to say is that great minds always think alike. So there's that as well. Yeah, man. So personally, I feel this 4-year cycle is a self-fulfilling prophecy. Will sold out, and now people are selling any rally as they feel we are in a bear market. Not buying will happen for a while. No buying will happen for a while. Yeah, I do agree. It's a self-fulfilling prophecy, but eventually it will end. Eventually it will end. Okay, that is one thing to keep in mind. The 4-year cycle, or however you want to call it, because some people fat shit at me for calling it a 4-year cycle, because 4-year cycles you should count from low to low. Well, okay, I do not really care. For me, the 4-year cycle is basically the halving cycle. Okay, 550 days after a Bitcoin halving, 1064 days after a Bitcoin bottom. We top. Okay, so this is my theory of a 4-year cycle. Anyways, eventually this 4-year cycle is gonna stop, and eventually we are gonna follow a liquidity cycle. Eventually Bitcoin is gonna follow its own super cycle, pretty much. Eventually this will happen. It will happen. It's inevitable. However, we do not know when it's gonna happen, and it's always better to stick with history, to stick with a proven track record, until proven otherwise. Okay, and right now we are not proven otherwise yet, so I'm still sticking with history with clear invalidations. Okay, I'm very aware of the fact that this 4-year cycle could end and we could see a lengthened cycle. That is also the reason why I've been saying that if we get back above the 50 weekly moving average, I will be very adaptive and I will be calling very quickly that maybe I was wrong and maybe I should get back aboard very quickly. I would like to see 10K daily green candles to confirm that we're still in a bull market. Yeah, I mean, I would like to see 100K daily candles to confirm that I'm still bullish. I don't know, man. 10K, I mean, could happen. Never say no, right? But for me, I do think that more likely we will see continued downside. Okay, smash the like buttons, guys. Yeah, for sure. Smash the like buttons. We're watching right now with 110 people, 20 likes. We can easily smash it up. It would really be appreciated because I'm literally doing these live streams for free now. I'm not gaining any benefit out of it. Okay, and to be honest, I'm streaming now while it is already pretty late. Okay, and I am a little bit tired. But still, I think this is very important. So that's why I'm watching it now. Optimize at least to be bullish. I mean, I would be flipping bullish already pretty early at the break back above 50 weekly moving average. I mean, it's pretty crazy that the biggest daily green candle we had was 8.3K so far. 8.3K, $8,300 US. You know how much that is actually? I am literally coming from the time from Bitcoin, and I think a lot of you guys are coming from this time, but it was literally sub 8.3K. And now the record is literally a 8.3K daily candle in just one day. That's crazy, guys. It's crazy if you think about it, right? I mean, I've seen Bitcoin at 3.5K with my own eyes. Which is pretty damn crazy. Big dump or pump. Let's see. I mean, like I've shared, it will be very important what will happen today during the meeting. And the interest rate cut itself is not really going to be that important. I mean, it has 90% probability, so it's already priced in. It's more that the dot plot and like the Fed meeting is going to be important. And also, if there will be no rate cuts, of course, we will see a fat dump. Is Powell coming on live stream after this conference? No, the crazy thing is, he will actually be streaming it on my stream. So, yeah. You see that door over here? And then I have another door behind that. I don't know if you can see it clearly on the stream, but basically 2 doors, right? He's coming from that door and he's going to be walking straight to my room and he's going to be saying, all right, we're going to introduce quantitative easing. So buy Bitcoin, buy Ethereum. This is getting out of hand now. Yeah, liquidate everyone. Let's see. I mean, we do always tend to see some crazy volatility during these events, right? Now, also, by the way, one thing to do keep in mind is that if you're interested in trading, just need to be saying it over on 2bit, you can claim $50 for free. Of course, by signing up an account already, only by signing up an account, but also if during this live stream you get a trading volume over 50,000 USDT, which is pretty easy to get, to obtain, very easy. you will get another additional $50 for free only for this live stream. So yeah, make sure to sign up an account with that link down below over on 2bit. If you have signed up an account with my link, any of my links, you'll be able to get a free 50 USDT by just trading a little bit. So I mean 7 minutes time, and then we will get our decision. We'll talk about the decision in a little bit. Show P&L. Well, I'm not logged in every exchange, man. I mean, you can always go back on my YouTube channel, watch every track record. You can always get back to all of my calls, right? If you are not interested in that, log in on one exchange and show P&L. Why would I be doing that right now during a stream? Come on, man. What altcoins are you buying next cycle? Next cycle, yeah, this is pretty interesting. I did a post about that in the Telegram channel. So coins that I want to accumulate later in a bear market, I want to accumulate Bitcoin, Ethereum, Dogecoin, probably. Pepe only if it shows relevance still some relevance in terms of social media dominance, but also some strength in price action, maybe a reaccumulation range, something like that. Mantle, I think, will be a pretty good coin to accumulate if Bybit, again, will still be relevant, will still be doing good, right? As long as Bybit will be doing good, I do think that it's a very, very good coin to accumulate. BNB as well, I really like BNB. If still Binance will be relevant, right? If Binance, for some reason, will be going over or will be going bust or something like that, well, then obviously not. Hype, also, if the metrics will allow, if the on-chain metrics of the volumes are still going up, if the chart is still looking okay, right? I want to accumulate hype, just like Aster. If the volume is still going up, if Binance is still relevant, I really like to accumulate Aster, just like Aave. Again, if the metrics allow, it's still very dependent on what the metrics, etc. will be. Link, WXT, WX token, Solana, and MSTR and Coin. So yeah, these are kind of the altcoins. But in 3 minutes time, we are about to get the interest rate decision. So 2 minutes and 30 seconds left. And I'm just quickly going to be sharing you what to look out for. If you've been watching me for a longer time, you already know it, but you need to follow multiple accounts on Twitter, turn on your notifications, and oh, whoops. I just want notifications on my phone. So there we go. So financial juice, follow him, follow me on X, Mr. Crypto, follow 3 News feeds, follow Zoomer Fight, and if you follow as many people, turn on your notifications for as many people, you'll get the data the first. You can go to your home following tab, and you'll see the data getting released, or you'll be notified by notification. So that's pretty much how you can get it. And then you'll be the first one to know. And after that, we will have a look into the report from the Fed, and that's always being posted by Financial Juice pretty quickly. Sui will be a big one. Kinda yes and no. I like Sui for this cycle because of its incredible strength. But it just depends in a bear market. I want to see like a strength continuing. Right? I want to see the metrics really confluencing with it. And if I'm having a look into Sui, like some things behind the back doors that's been happening, like market making stuff, etc. Like I don't think it's gonna be sustainable in a bear market. Yeah, man, I am sitting indeed on incredible losses. I'm really struggling to pay the bills, my man. If you want to believe that. So there we go. 1095. Anytime soon. 10 seconds. I think it's about time, so data can come in any moment. Yes, 25 basis points. Okay. As expected. 25 basis points. Posted there. Yeah, 3 News feed. Oh, Phoenix also posted. But oh, Phoenix posted it kind of first. That is pretty interesting. But now let's watch the document and let's watch what the price action is doing. I mean, was kind of to be expected, right? Only 10% didn't expect it. Yeah, so a bit of a bump. Nothing much. Yeah, man, I have so many losses I'm hiding right now. Anyways, let's have a look into the document. Additional adjustments, that's good. Nothing that interesting over here. Maximum employment and inflation at 2%. Yeah, nothing that interesting. Nothing that interesting in the document. So kind of to be expected is rate cut. So now what will be important is going to be, of course, obviously, the What's he saying? Yeah, man. Yeah, man. Like, it's crazy. He just doesn't understand. I want to open up, or I don't even want to open up like Bybit or something right now. Like, why should I? Hoping for a Christmas rally or New Year rally. I mean, previously, historically, we did see some Christmas rallies, which could be the next narrative, right? So that could be pretty interesting. Uh, do you recommend being in all cash ever? Uh it's a tricky question to answer. It depends. It depends a lot. I don't think all cash is the right move to make. Why are you struggling to pay the bills? You post trades, man. It's a joke. It's a joke, my man. But recommend being in all cash. No, I would not recommend that, to be honest. Even if you're expecting a big crash, I still, I mean, I cannot recommend anything. I cannot do any financial advice, right? But I would never recommend being in all cash, um, for myself personally, because there's always a chance that Bitcoin will just continue to go to the downside. Keep in mind, Bitcoin is the greatest asset on earth, right? And even if you're not going to be exposed to, for example, the crypto market, at least be a little bit exposed to the stock market or any other market, right? Bro, the thing is, like, I'm really, like, I'm not gonna be explaining myself anymore. If you just want to argue about these things more and more, like, please do not come here. Just leave the stream, okay? Thing is, you're talking about liquidations after screenshots multiple times longing with leverage. Like, at the end, that's true, but you didn't watch what I was saying in any of my videos. So if you do not watch anything what I'm saying in any of my videos, then, like, why should I be arguing with you? Why should I be talking with you? Thing is, I've been very bullish throughout the entire bull market, and only in the end stage of the bull market, I did still say we have a possibility of coming even further to the upside, but I was talking about all of the warning signals. I've been talking about all of the facts that in a long term we are very close to a top, and I have been talking about in all of my live streams, in literally at the exact Bitcoin top, I've been talking and saying the fact that I'm taking profits on spot, but I do not want to be left out for the opportunity that if we do decide to go even higher. So that is why I've been selling off spot. I've been taking some of that money to be putting in leverage positions to still be exposed to the crypto market with a good risk profile, with good risk management. And I'm not going to be losing out on potential upside gains. And I'm not going to be losing out if we do crash even lower, because I was taking my profits. Now, do you want me to sit here, open up my Bybit account, show all of my spot buys and spot transactions? No, I will not be doing that. I mean, even though some people might have said, oh yeah, every YouTuber should share all of their P&Ls on all of their exchanges. No, obviously not. I should have the right to remain, to have some privacy. I mean, you know what kind of stuff has been happening to some of the people that are showing their net worth, their trades, their this and that. I mean, it's not great. I've been hearing some stories. It's not great. I will not be sharing these like things publicly, which make me vulnerable, right? Why should I be doing that? That's absolutely stupid. So please stop with like these nonsense. Yeah, indeed, I never reply, but like they're taking up so much, you know, space right now in the live chat. Everybody is noticing it. So I just think it should be getting addressed once and for all. And if you do not like it, well, then just leave. Just leave. Okay, it's not that freaking hard. Just leave. I mean, bad calls were made. It's not really. I mean, if you want to call it bad calls, sure, man, sure. I mean, that's the thing, right? Just watch my videos and do not watch only my YouTube title and thumbnail. Just watch the entire context and watch entirely what I'm saying. If you do not miss like a video, I'm very certain you're in the same boat as me. And I'm in a pretty good boat. So, yeah, don't waste your energy, indeed. Bro, I have been saying I'm not gonna be opening up any exchange here live. And also, I'm not gonna be opening up anything I do not want to here live. Why should I be doing that? Yeah, man, for sure. Yeah, for sure. So yeah, right now I'm just yeah. What? What? Ah, man, I'm just gonna block you right now, man, because this is like entirely not true at all. I have been saying many times, even if the crypto market might see a bit of a dump, I think stocks will be holding much stronger, and the S&P can still easily reach new all-time highs, while crypto can be dumping, because this is exactly the 2019 scenario where I've been talking about very often. So, I mean, you have just not been watching my channel. Please just ignore it. Please just go away in that case. Oh yeah, for sure. Thank you so much. Um, yeah, I mean, let's just get on with the content right now, right? So next up, what will be important next up in 20 minutes? Of course, the FOMC meeting itself. So that will be important to be having a look into. Now, the interest rate cut, kind of this 25 basis point rate cut, was to be expected. So nothing too special about that. It was more that if, and that's also the reason why the markets are still kind of consolidating a bit. I mean, it's a bit of volatility which we are seeing, right? It's actually quite some big moves, like 1% moves, swings of up and down. That's quite insane, quite crazy. But the real stuff, I think, will be happening after the FOMC meeting. Now, actually, let's create a poll. Start a poll. What will happen after the FOMC? Okay. So not like what will happen during the FOMC meeting, but after the FOMC meeting, the next few days after, will we see a pump or a dump? Because historically speaking, we have seen dumps, right? But maybe potentially this time could be different. So pump or dump? Let's see. What will happen in 2026? QE and new liquidity. Yeah, I do think it's gonna be pretty likely. However, I do like as it stands currently. If we're having a look into like the probabilities for rate cuts, they want to remain to hold the interest rates at pretty much 3%, right? So 3% is not going to be the stage where aggressive money printing is going to be getting introduced, in my opinion. So I do think that in order to see real true QE something first still has to break in the economy, like for example has happened in 2020, right? 2019 we have seen interest rate cuts, the end of QT, the stock market still pumping very nice. Then we have seen an economic collapse and like a big kind of recession, big economic slowdown. The Fed needed to jump in and save the economy by putting the interest rates back at 0% and introducing QE. And then we saw the massive bull market, right? So I do think if we really want to see the true powerful QE again, I do think we need to see a similar situation, just a slow and steady bear market, and then somewhere economy collapsing with a big crash to the downside. Then the Fed will jump in and save it again, and then happy days, we will go to the upside again. So yeah, it's a projection to see QE by 2026. It really depends, right? I do think it will be pretty likely, but as it stands right now, well, with interest rates at 3%, I do not think we are going to be seeing the real true QE we really want to be seeing. So yeah, I should, like, I do not want to be the guy that wants to hope for like a big economic downturn or big event, like for example C19. I do not want to be the guy that is hoping for that at all, but it will help the economy, and without that, I do think we can have a look into maybe another scenario unfolding, which in the long term isn't going to be that bad, but it's going to be worse for the short term price action, what we want to see. If we open up the interest rates over here, this is the scenario I've been talking, like either we are going to be seeing this 2019 scenario, right? With stock market still rising, Bitcoin crashing, then see the COVID crash, and then push to the upside again. Either this over here with a projection to see interest rates like this, but the Fed just needs to jump in and cut the rates. Either that, or if the economy is still going to be very strong, I think a scenario like over here could very well play out with interest rates getting cut, okay, for a long time, stock market still rising very steadily. Kind of interest rates jumping around, then rising, and then it broke, okay? Then it broke. But only after like 6 good years. I mean, after this point over the initial rate cuts over here, still took about 1,060, 1,650 days after the first initial rate cut. So that can still take a while, right? If the economy is still going to be holding great. So that's the thing. If the economy is still going to be holding great, I think more kind of a scenario like this would be unfolding. If something breaks in the economy, then a scenario like this would be unfolding. But like you can see, I mean, over here we saw some very nice price action, but it was more a slow and steady rise. I think we are going to be seeing the same thing for Bitcoin in this case, right? Some slow and steady rises. But if something breaks, we're going to see a very good buying opportunity, and then some very, like, even more extraordinary pushes to the upside. So yeah, that's the thing, right? I do not want to be hoping for something to break. I do not want to be rooting for the economy to break or for something to collapse. Not at all. I do not want to be this guy, okay, that thinks, oh, I want a war or something to happen because I want to buy at cheaper levels. No, not at all. Like, this would ultimately be the best scenario. However, this could also be happening. And if this would be happening, I am going to be buying it hard. So these are going to be the two scenarios, given interest rates and monetary policy, etc., that I will be watching out for myself. What does it mean if Fed starts buying treasury bills? Well, basically, a little bit of QE, or kind of stealth QE. Trump will replace Powell. He's gonna do something. I mean, he cannot replace Powell really right now, but I do think that Powell will leave eventually, and we will get a very nice, good share Fed chair later. Now, one thing is, at one side, of course, we want lower interest rates. At the other side, isn't it pretty good actually what's happening now with interest rates being pretty high still, stock market still exploding to the upside? I mean, the only thing is pretty much the weakening labor market. But apart from that, the Fed has handled it pretty well, right? So yeah, do we really want these extremely low interest rates? I mean, for sure, for the short term, right? But I think for the long term, this is like handled very well. Yes, exactly, Axel, with the proper information. Let's load up the stream already. Uh, there we go. So then soon we will be able to watch it. Let's go. Oh yeah, by the way, they just announced 40 billion US dollars worth of treasury bills indeed over the next 30 days to buy. Um, this is pretty bullish. The market didn't really pump that much on it, but pretty bullish. 10 minutes left right now. What is the actual problem? Bitcoin got a great run from the bottom, major alts too. What's the problem? I don't get the problem either. Yeah, when content creators hate on the Fed, that pretty much tells me everything about them. Indeed, I mean, you still got to give them props, right? They handled it pretty well. If you've got to be honest, like, wait 1 second, my doorbell is going. Oh shit, no sound. Yeah. No, I was just saying first, it was a delivery guy. He's got the wrong door. So yeah. But yeah, the Fed will always be the most hated no matter what. Kind of impossible job to try and steer the economy. I mean, it's true, right? Because either you have too high inflation, people are hating on you for that. Either it's too high interest rates, people are hating. And like people always want lower inflation, lower interest rates at the same time, a strong job labor market. It's kind of hard, right? And people always think they know it better, you know. So yeah, 5 minutes. 5 minutes left. Let's go. It's 4 minutes left. So yeah, let's see. Let's see. By the way, I do still want to mention that before we're gonna have a look into the meeting, you can still claim this 50 USDT by getting a trading volume above 50K, right? So yeah, you can check that one out. Only for during the live stream. So if you're trading during the live stream with the link below, I mean, you can also already get a free 50 USDT by just signing up. But if you get an additional 50K deposit trading volume, you're going to be getting another 50 USDT by just trading. So yeah, check it out with that link, right? Anyways, 3 minutes time. Are you in any trades? No, I've been explaining though my trading setups, what I'm looking for in my last few recent videos. So make sure to check that one out. I'm still kind of waiting for either a push to the upside here or push to the downside. I've been talking about it many times that the halving effect becomes less and less effective as more Bitcoin already are in circulation. That's very true, and that's also exactly the reason why I've been saying many times that eventually Fourier cycle or Bitcoin halving cycle will not work anymore, and we will decouple from it. 1 minute time. Let's load up the stream. will be able to watch it. There we go. Look at the poll. Yeah, it's kind of almost 50-50. Slightly in favor of the dump. All right, let's go.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although important federal government data for the past couple of months have yet to be released, available public and private sector data suggests that the outlook for employment and inflation has not changed as much since our meeting in October. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals, in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. As a separate matter, we also decided to initiate purchases of shorter-term Treasury securities solely for the purpose of maintaining an ample supply of reserves over time, thus supporting effective control of our policy rate. I will have more to say about monetary policy and its implementation after briefly reviewing economic developments. Although some key government data have yet to be released, available indicators suggest that economic activity has been expanding at a moderate pace. Consumer spending appears to have remained solid, and business fixed investment has continued to expand. In contrast, activity in the housing sector remains weak. The temporary shutdown of the federal government has likely weighed on economic activity in the current quarter, but these effects should be mostly offset by higher growth next quarter, reflecting the reopening. In our summary of economic projections, the median participant projects that real GDP will rise 1.7% this year and 2.3% next year, somewhat stronger than projected in September. In the labor market, although official employment data for October and November are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. The official report on the labor market for September, the most recent release, showed that the unemployment rate continued to edge up, reaching 4.4%, and that job gains had slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. In our SEP, the median projection of the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Very little data on inflation have been released since our meeting in October. Total PCE prices rose 2.8% over the 12 months ending in September. and excluding the volatile food and energy categories, core PCE prices also rose 2.8%. These readings are higher than earlier in the year as inflation for goods has picked up, reflecting the effects of tariffs. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have declined from their peaks earlier in the year, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.9% this year and 2.4% next year, a bit lower than the median projection in September. Thereafter, the median falls to 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.5 to 3.75%. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. A reasonable base case is that the effects of tariffs on inflation will be relatively short-lived, effectively a one-time shift in the price level. Our obligation is to make sure that a one-time increase in the price level does not become an ongoing inflation problem. But with downside risks to employment having risen in recent months, the balance of risks has shifted. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. Accordingly, we judged it appropriate at this meeting to lower our policy rate by a quarter percentage point. With today's decision, we have lowered our policy rate 0.75 of a percentage point over our last 3 meetings. This further normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2% once the effects of tariffs have passed through. The adjustments to our policy stance since September bring it within a range of plausible estimates of neutral and leave us well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of 2026 and 3.1% at the end of 2027, unchanged from September. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. Let me turn now to issues related to the implementation of monetary policy, with the reminder that these issues are separate from and have no implications for the stance of monetary policy. In light of the continued tightening in money market interest rates relative to our administered rates and other indicators of reserve market conditions, the committee judged that reserve balances have declined to ample levels. Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities, mainly Treasury bills, for the sole purpose of maintaining an ample supply of reserves over time. Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets. Thereafter, we expect the size of reserve management purchases to decline, though the actual pace will depend on market conditions. In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled by the setting of our administered rates, rather than day-to-day discretionary interventions in money markets. In this regime, standing repurchase agreement, or repo operations, are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee eliminated the aggregate limit on standing repo operations. These operations are intended to support monetary policy implementation and smooth market functioning, and should be used when economically sensible. To conclude, the Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing our inflation sustainably down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Fed, we will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Howard.
Thank you. Howard Schneider with Reuters. Just first turning to the statement, just to be clear, we're on the same page here. The insertion of the phrase, considering the extent and timing of additional adjustments, does that indicate that the Fed is now on hold until there's some clearer signal from inflation or jobs or the evolution of the economy along the baseline outlook?
So, yes, the adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
And if I could follow up on the outlook there, it seems like with the additional GDP growth coupled with easing inflation and a fairly steady unemployment rate, this seems like a pretty optimistic outlook for next year. What's given rise to that? Is this an early bet on AI? Is there some sense of improving productivity out there? What's driving that?
So a number of things are driving what's happening in the forecast. And I would say if you look broadly at outside forecasts, you do see a pickup in growth in many of those now too. So it's partly that consumer spending has held up. It's been resilient, and to another degree it is that AI spending on data centers and related to AI has been holding up business investment. So overall, the baseline expectation for next year is, at least at the Fed, and I think with outside forecasters too, is a pickup in growth from today's relatively low level of 1.7%. I mentioned that the SEP median is 1.7 for this year growth and 2.3 for next year. You actually, some of that is due to the shutdown. So you can take 0.2 out of 2026 and put it in 2025. So it would really be 1.9 and 2.1. But overall, yes, for a few reasons, fiscal policy is going to be supportive, and as I mentioned, AI spending will continue. The consumer continues to spend, so it looks like the baseline would be solid growth next year.
Steve.
Thank you, Mr. Chairman, for taking our questions here. You had previously described rate cuts in terms of a risk management framework, and kind of following up on what Howard was asking, is the risk management phase of rate cuts over here, and have you taken out sufficient insurance, I guess, against potential weakness in terms of the data we might get next week when it comes to employment?
So we're going to get a great deal of data between now and the January meeting, and I'm sure we'll talk more about that. And the data that we get are going to factor into our thinking. But yes, we have, if you go back, we held our policy rate at 5.4% for more than a year because inflation was high, very high, and unemployment and the labor market was really solid at that point. So what happened is over last summer of 24, inflation came down, and the labor market began to show real signs of weakness. And so we decided, as our framework tells us to do, that when the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. And so we did that. We did some cutting, and then we paused for a while to work our way through what was happening in the middle of the year. And then we resumed cuts in September, and we've cut now 3. We've now cut a total of 175 basis points. And as I mentioned, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
If I could just follow up on the SEP, you have a whole lot of big increase in the growth numbers, but not a big decline in the unemployment numbers. And is that an AI factor in there? What is going on in terms of the dynamic of you get more growth, but you don't get a whole lot of decline in unemployment? Thank you, sir.
So the implication is obviously higher productivity. And some of that may be AI. It just also, I think, productivity has just been almost structurally higher for several years now. So if you start thinking of it as 2% per year, you can sustain higher growth without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of time. So it's basically a good thing. But that's certainly the implication.
Thank you. Colby Smith with the New York Times. Today's decision was clearly very divided. It wasn't just the 2 official dissents against the cut, but there were also soft dissents from 4 others. And I'm just wondering if this reluctance from several people to support recent reductions suggests that there is a much higher bar for cuts in the near term. And what exactly does the committee need to see if things are well positioned right now to support a January reduction?
Sure. So let me just say, as I mentioned, and as I've mentioned here before, the situation is that our 2 goals are a bit in tension, right? So interestingly, everyone around the table at the FOMC agrees that inflation is too high and that we want it to come down, and agrees that the labor market has softened and that there's further risk. Everyone agrees on that. Where the difference is how do you weight those risks, and what does your forecast look like, and where do you, ultimately where do you think the bigger risk is, and it's very unusual to have persistent tension between the 2 parts of the mandate, and when you do, this is what you see, and I think it's actually what you would expect to see, and we do see it. Meanwhile, the discussions we have are as good as any we've had in my 14 years at the Fed. They're very thoughtful, respectful, and you just have people who have strong views, and we come together and we reach a place where we can make a decision. We made a decision today. We had 9 out of 12 supported it, so fairly broad support. But it's not like the normal situation where everyone agrees on the direction and what to do. It's more spread out, and I think that's only inherent in the situation. In terms of what it would take, we all have an outlook in terms of what's going to come, but I think ultimately having cut 75 and the effects of the 75 basis points will only begin to be coming in. As I've said before a couple times, we're well positioned to wait to see how the economy evolves. We'll just have to see. And we will get, as you know, quite a bit of data. I should mention on the data, as long as I'm talking about it, that we're going to need to be careful in assessing, particularly the household survey data. There are very technical reasons about the way data are collected in some of these measures, both in inflation and in labor, in the labor market, so that the data may be distorted and not just sort of more volatile, but distorted, and that's really because data was not collected in October and half of November. So we're going to get data, but we're going to have to look at it carefully and with a somewhat skeptical eye by the time of the January meeting. Notwithstanding that, we will have a lot of the December data by the time of the January meeting. So we expect to see a lot more, but I'm just saying that what we get for example, CPI or for the household survey we're going to look at that really carefully and understand that it may be distorted by very technical factors.
And just one more question on dissents. I mean, you talk about it in a very positive way, just given the complicated nature of the situation we're in economically. But is there any point in which those dissents become counterproductive, either to the Fed's communication and the messaging around the policy path forward?
I don't feel that we're at that point at all. I don't. I would say, again, these are good, thoughtful, respectful discussions, and you hear people say, and you hear many outside analysts say the same thing. I could make a case for either side. I mean, I could make that case. It's a close call. We have to make decisions, and we always hope that the data will give us a clear read. But in this situation, you have competing. If you look through the SEP, you'll see that a very large number of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. You can't do two things at once. So at what pace do you move? What size moves do you make, and that kind of thing? And what's the timing of them? It's a very challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, there's been some discussion recently of the 1990s. In the 1990s, the committee did two discrete sequences of 3 quarter-point cuts, one in 1995-96 and one in 1998. And after both of those, the next move in rates was up, not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down, or should we think of policy risks as genuinely two-sided from here?
So I don't think that a rate hike is anybody's base case at this point, and I'm not hearing that. What you see is some people feel we should stop here and that we're at the right place and just wait. Some people feel like we should cut once or more this year and next year. But when people are writing down their estimates of policy of where it should go, it is either holding here or cutting a little or cutting more than a little. So I don't see the base case as involving that. So of course, a data set of 2, now 3, is not a big data set. But you are right about those 2 3-cut times in the 90s.
If I could follow up, the unemployment rate has been rising very gradually for the better part of 2 years, and indeed the statement today no longer describes the unemployment rate as remaining low. What gives you confidence it won't continue rising in 2026, especially when housing and other rate-sensitive sectors still appear to be feeling restrictive policy from the, notwithstanding the 150 basis points in cuts prior to today?
So I think the idea is that with now having cut 75 basis points more now and having policy, I'd call it in a broad range of plausible estimates of neutral, that will be a place which will enable the labor market to stabilize or to only tick up 1 or 2 more tenths, but we won't see, any kind of a sharper downturn, which we haven't seen any evidence of at all. At the same time, policy is still in a place where it's not accommodative, and we feel like we have made progress this year in non-tariff related inflation, and as tariffs come through, as they flow through, that'll show through next year. But as I said, we're well placed to wait and see how that turns out. That is our expectation, but we're going to start to see the data, and it'll tell us whether we were right or not.
Claire.
Claire Jones, Financial Times. A lot of people interpreted your comments at the